You walk into a store, tap a piece of plastic, and walk out. For the next 30 days, you don't pay a single cent of interest on that purchase. In fact, your bank might even give you 2% cash back, some airline miles, or free airport lounge access just for tapping. It feels like a glitch in the system. If you are borrowing their money for free and getting paid to do it, how are these financial institutions pulling in billions of dollars in revenue every single year? The answer lies in how they classify you. The credit card industry operates a dual-engine machine. They sort their millions of customers into two distinct groups, and they extract profit from each side in completely different ways. To figure out if you are gaming the banks or if the banks are gaming you, we have to look past the plastic and see the financial network running underneath it. Let's start with the first group, the transactor. This is the customer who pays off their balance in full by the due date every month. If you are a transactor, you probably assume you are a drain on the bank's resources because you avoid paying them any interest. But you are highly profitable. Whenever you tap your card, you trigger what's called a four-party model. This flowchart maps the split-second journey of your payment. Your tap starts the interchange engine. The merchant's bank is forced to pay a fee, usually between 1% and 3% of the total purchase, directly back to the bank that issued your card. And that is where your perks come from. Your bank takes a slice of that interchange fee and hands it back to you as cashback or airline miles, keeping you loyal to their specific piece of plastic. Connecting all of these banks are the card networks. Companies like Visa and Mastercard don't actually lend out money. They operate the digital rails between the banks, acting as toll collectors, taking a tiny cut of every single transaction on the planet. So those free flights and cashback bonuses are heavily subsidized. They are paid for by a hidden tax levied on every merchant you visit. And to cover that tax, merchants raise the baseline price of their goods, which means everyone, even people paying in cash, is quietly funding your rewards. But interchange is only half the equation. The real money is made on the second group of customers, the revolvers. These are the cardholders who carry a balance from month to month. Take a look at this comparison. The tiny column on the left is the bank's cost of funds, what they pay to borrow money. The towering column on the right is the annual percentage rate they charge a revolving cardholder. That massive gap is their net interest margin. That spread is often the widest of any common consumer loan. Because of those high interest rates, revolvers generate substantially more revenue than transactors. They are the true profit engine of the entire industry. But lending money this way is dangerous. Credit cards are unsecured loans. There is no car or house for the bank to repossess if a customer stops paying. If a revolver defaults, the bank just has to absorb the loss. To defend against this, issuers rely on massive scale and machine learning. They process millions of data points in milliseconds, predicting with high granularity exactly who will carry a high interest balance without sliding into insolvency. The entire business is a high-wire act. Issuers are constantly tweaking their algorithms to encourage just enough consumer debt while precisely calculating how much cash they need to hold in reserve for the inevitable defaults. For decades, this dual-engine machine has been stable, but consumer habits are shifting. Younger, debt-averse shoppers are abandoning traditional credit cards for buy now, pay later platforms, securing zero-interest installment loans without the plastic. At the exact same time, real-time digital bank-to-bank payment systems are taking over merchant counters worldwide. These setups allow consumers and merchants to transact directly, completely bypassing the traditional card networks and their lucrative interchange fees. Regulators are also circling. Agencies like the Consumer Financial Protection Bureau are heavily scrutinizing the affordability of rising consumer debt and the fairness of how these credit lines are marketed. To survive, card companies are embedding their services directly into non-financial apps. They are partnering with retailers and software platforms to issue loans invisibly, offering personalized installment plans right at the digital checkout line. Zoom out, and the credit card industry reveals itself as a massive wealth transfer system. It continuously moves money away from merchants and indebted revolvers and funnels it upward toward the issuing banks and the reward-collecting transactors. You are operating inside that machine every time you buy something. Your only real defense is knowing exactly how it works, utilizing the network's rewards, and making absolutely sure you remain a transactor, never a revolver.